Hello, this is Steve Samangelo once again from the SRS Rock Report, and I have a new update. It's been a while. This is an important update on some new information. It's going to be on gold, silver, and the markets. What's next for 2019? Now, before I get started, I wanted to say that I've been looking at some new information, how the market trades, day trades, and watching how prices of stocks, watching how they trade up and down around these support and resistance levels. And what I found through looking at this technical analysis is that there's kind of a crystal ball on where the prices, where they can go. And so we have two aspects, which one of the aspects of analysis is what I mainly focus on, which is fundamental analysis, which is the energy, how it impacts the markets, whether it's the oil price, the falling energy return on investment, cost of production for gold and silver, and supply and demand. And then we have technical analysis, which is how the market is trading, which are day traders, swing traders, long-term investors, hedge funds, major institutions, and all of these trade in around technical analysis levels. And I have in the past kind of dismissed technical analysis, but in looking at this information, it does provide a kind of a crystal ball of where the prices can go. And so let's start the first chart on the Dow Jones. Now, the Dow Jones is the major market, broader market indicator of the economy. And here, this is a 20-year chart. And what we have here are these important levels. Now, the first level is 8,000 on the Dow Jones, and it has been a major support level for 20 years. We could see in 2002 and 3, and even 8 and 9, that this was the support level. Now, the 11,000 was this next level, and we could see in 99 and 2000 and 2001, the Dow Jones continued to press up against it, but it never really went above it. It finally corrected during the this 2002 period, and then it went back up. And we could see it bounced up above it. Now, in 2006, the Dow Jones finally went above the 11,000 and reached this next level, which is 14. And as we can see, it went up to the 14,000 level, and this is in 2007 when we had the peak of the market, and then we had the big crash. Went right through this 11,000 and right down to the 8, bounced off it. Now, when the markets corrected, we could see in 2010 it was the resistance level, and then it went above it. It became the support level, and then again, when the QE, with the Fed QE really hit the markets, it pushed the Dow to new highs. And so as we can see, the Dow Jones went above the 14,000 level, and then the next level is 18,000, which was the new resistance. And we could see the market corrected, went back above it. And it wasn't until 2017 that the Dow moved quickly above that 18,000 level, and then it hit to 24,000. Now, even though the Dow Jones went to 26.5 in the beginning of the 2018, fell below it, and then to 27, we can clearly see this 24,000 has been a major support. Now, once the markets finally roll over, and the markets will roll over, we could see the next support levels are here, but we have to also look at these moving averages, and I'll show how much of a role that they play. But I do believe the Dow Jones will eventually move back to this 8,000 price level. Even if we have hyperinflation, at some point in time, it will crash down to that level. Now, I want to focus on the oil price because the oil price is the major indicator of what happens in the market, especially, when the oil price hit 145 in 2008 or 2007, 8, it crashed all the way down to 30 by 2009, and everything fell. All the markets, the commodity prices, stocks, all crashed. Now, interestingly, this is a monthly chart, so we have a 50-month moving average in blue, a 100-month moving average in red, and a 200-month moving average in the green. And right here, we could see that the oil price continued to bounce off that support level. until it fell considerably and it went through all these levels, even the long-term 200-month moving average. But when it corrected higher, it didn't go above it. So this now became an important resistance level. Well, then oil continued to sell off. And just make sure you all know, each candlestick is 1 month of trading. When oil fell to a low of 25 at the beginning of 2016 and corrected, it went back up to that important 200-month moving average, and that was its resistance level. And this here became the support level. Once it went above it, then we could see the 100-month moving average now is resistance. And so the oil price trades, even though it goes briefly above it, it doesn't close above it. Now, these last 2 months, we can see the oil price has sold off significantly. It peaked at 77, and right here, and this was on November 20th, it was trading at 53.43, right down to the 50-month moving average. Now, this is November 30th. At the end of the month, the oil price fell below this crucial support level to 50.93. Now, if we look recently, which is as of trading yesterday, December 4th, this is a new month for December. Now, the oil price started to trade right below that moving average and shot above it. Now, it can continue to move higher, and I'll show you why, because nothing goes down in a straight line. We always have corrections. If we look at a weekly chart, and this is a 50-week moving average, we have now a 100-week moving average and a 200-week moving average. When the oil price fell from 77 all the way down to 50, these are weekly candlesticks, it fell below that 200-week moving average, but here in this present week, it's now the support level. And I believe nothing goes down in a straight line. As we can see, the MACD could turn up. The oil price will attempt, if it will go higher, it will attempt to take out this average of 58.31. And I don't think it's going to move much higher than that, because right now we're in the winter driving months. So demand for Americans using oil falls to a low. And then if you add on top of all the contraction we're starting to see in the housing market, to higher interest rates, and the housing prices and housing sales are falling, and the overall economy is rolling over. So I do believe we're going to see much weaker demand, which is going to impact how much the oil price can increase. I believe even if it goes up to this level, it's going to go lower. Now, even if it goes up to 58, it'll spike higher, and it could still remain below that. Now, I've added 2 more moving averages. Yes, this sounds like it gets a little crazy. We've got the 300-month moving average in orange and the 400-month moving average in purple. But look what happened here. You remember when the oil price fell, I showed you the other chart, it fell below the 200-month moving average. Well, look where it fell to. The 300-month moving average became the support level. Even though it would trade up above that, this was the major support level. Went up to the 200-month moving average, went back down, and then it traded, and this became resistance until it fell. And it was resistance here, even though it went about above it. It became another resistance level here. Now, it's fascinating. We also have the 400-month moving average, and it's such a long average, it doesn't start until 2016. But interestingly, the oil price fell down to that 200-month moving average here. So we could see that the oil price moves in and around these levels. It is fascinating how these levels become a support and resistance area. Now, this is a major downtrend, and they call this a triangle. And the oil price hit a high of 145 in 2008, and then it fell all the way down to 30s in 2009. And interestingly, that was the major support level, the 200-month moving average. It fell all the way down to that. Unfortunately, the oil price has been hitting up against this downtrend triangle line. Again, This is what technical analysis looking at the markets use. And we could see 1, 2, 3, 4 times that the oil price has hit this important technical triangle line. Now, it's trading right about here at 53, 54. However, if this continues, the oil price will be deflationary, especially if the markets continue to slow. Now, this does not mean that it's impossible for the oil price to go above this. It could go above this, especially if we have a geopolitical event in the Middle East, or if we have massive money printing. Then the oil price could go up, but everything would go up. It would be hyperinflation. And that would lead to a collapse similar to Venezuela. It wouldn't last but a few years. So this is very bad news for the oil price. I do believe the oil prices could continue to fall, and that's bad news for the U.S. shale oil industry, the tar sands industry in Alberta, and especially the overall economy. Now, I wanted to show you how the technical analysis has been impacting the silver price. Now here we had a major increase in the silver price due to not only the oil price going up, we had a huge demand, investment demand, physical demand, retail paper demand, as well as industrial demand. And it pushed silver to a new high of 50. And as the silver price corrected, this was a major support level of 27.5. We could see it. Now, when the silver price fell, it traded again around its moving averages. This is the 100-month moving average. It traded to it, fell below it, and then it became the resistance. Now it's fascinating. We have this long 200-month moving average in green, and silver has been trading above and below these two averages until it came to a pinch here. Now normally this can happen in two ways. When it pinches, it can move up, or the price will move down. And this time it moved down, which is a bearish indicator for the overall market. However, what we have here is a double bottom. The price of silver fell to 14 at the end of 2015, and then it fell again currently. It's been trading at this double bottom. Now, there's a reason why we have this double bottom, to me, is the cost of production, and I'll show you. Now, the cost of production for the silver miners is between 15 and 16, and now the silver price, this is the average cost of production now of the primary silver miners, right about here. It's traded below it, it's traded above it, and now it's below it again. Now, what's fascinating, the gold price of $1,200, the cost of production of $1,200, compared to silver between 15 and 16 gives us a cost ratio of 80 to 1. Now, isn't it ironic that the gold and silver price are trading right around that 80 to 83 to 84 to 1 ratio? And I believe the algorithms, the traders in the market, this is how they're determining the price, based upon this cost of production. Now, of course, when the silver price shot up, demand was so high, it pulled the price higher than the cost of production. And I'll get into that in a minute. But again, this is the reason why we're seeing this double bottom, because the traders and the market realizes that silver's cost of production, even a little bit more volatile than gold, this gives it a pretty good floor. Now, in one of my previous articles, I showed you the all-in sustaining cost of the top primary silver miners. And as we could see, the ones in red are above, and this was the market price at the time. I believe the price was $14.02 when I did this chart a few weeks ago. It's now trading at $14.40, $14.50, and there are only two companies here, Pan American and Fortuna, that are producing all-in sustaining costs below the silver price. So again, that silver break even is about $16. Now, I wanted to show you Pan American silver, which is over a long-term basis, and many of you have seen this chart, but this shows you on a long-term basis of one of the second largest silver producers in the world. Now, the white line shows the average annual price, even though the price of silver in 2011 jumped up to 50 and then went lower, its average annual price was 35. And this line here shows you Pan American Silver's profit in green or lost per ounce that year. And for most of the time, it was either a little bit above or below. But for these 2 years, when we had huge demand and much higher prices, Pan America was enjoying nice profits. But if we look at overall, the silver price was trading around their cost of production. Now, just like with the oil price, I added a couple of more moving averages. Why? Because if we cannot dismiss technical analysis and how I can no longer avoid or dismiss how technical analysis and traders are going to trade the silver price. I've got to look at it because they determine the short-term price, not based on fundamentals, but more based on technical analysis and how they see the markets trading. Now, here is that double bottom, but if the oil price does fall down to 40 and 30 possibly, and even the 20s, if it's a huge crash in the price, that's going to impact the silver price cost of production. So I added these extra moving averages to show how the extreme possible lows that silver could get to. But even if they get that low, they're not going to remain that low. And the reason why I believe that is due to the fundamental analysis. Because the silver price has fallen to its low, especially its cost of production low, it is closer to its base price, whereas the market, the stock market, it's closer to its high. So as I've shown in previous articles, when we've had some big sell-offs in the market, when the Dow Jones fell 2,000 points in October, in 2 days, the gold and silver prices shut up. I believe the gold price went up $50. So once fear comes in the markets, we'll see a disconnect. We'll see the silver and gold price move up, and we'll see the markets start to decline. And this will be a market we've never experienced before. Now, I wanted to show you the same thing with gold, with the moving averages, as well as this major cost of production support level. Now, the gold price shot up, peaked at 1,900 in 2011, and as it sold off, we could see it did trade around its moving averages, but we'll see that this level was its major support level. Why? Because this is now what it cost for the gold miners to produce gold. And these are the average prices for the year. But again, this is what the mining industry can produce gold. And why is that important? Well, I published this chart several times, and I want to show you it again because it needs to be understood, especially in 2004. 2004, Barrick and Newmont, the top two gold miners, their cost of production was $366. The average price that year was about $400. So they're making a little bit of money. Now, remember 2016. In 2016, the price of their cost of production was about $1,123, and the market price was about $1,250. So they were making profits. But again, compared to 2004, their cost of production in 2016 was about 3 times higher. Now, why is that important? Well, before I get into that, I wanted to show you again a quick review. These are the top 5 gold miners. Barrick had a much higher cost because they produce a lot of base metal, byproduct base metal, as well as silver, and those prices have not held up as well as gold, so their costs are higher. But if we look at the weighted average for the group for the first 3 months of this year, it's $1,204, about $1,200. And now the current market price at the time of this chart was $1,221. It's even higher now. I think it's $1,240. But we can still see this is the weighted average to produce gold. Now, why is that important? I published this before, but I wanted to review it again because it's important for people who still believe the gold price can fall to these levels. This is Harry Dent's famous chart forecast of the gold price falling to 700 and then 450. The reason why he believes that, he superimposes a bubble chart, and this is like Bitcoin, and this is what it should get back to. However, as I mentioned, when silver was trading at $400 an ounce, the cost of production was much less. And let me show you. When the oil price, it was $41.51 in 2004. It cost Barrick and Newmont $366 to produce the gold. Even though the oil price had fallen in 2016 from 110 down to 43, it was only a few dollars more than 2004. Now, this isn't the oil price, this is the gold price. But the oil price was only $2 more than it was in 2004. But the reason why it stopped here was this is the gold production floor for the gold mining industry. It's this $1,200 level. And even though the gold price, the oil price has gone up, and this was the average for 2018, 67.55. Instead of the market price selling off, it cost more money to produce gold. Again, it's at this $1,200 level right here. So even if the oil price falls down to 30 or 20, I don't see the price ever getting back to here, because at the lowest, we could see maybe gold trading at $1,000. The cost of production could get down to $1,100, $1,150. We could see on $1,100 price or $1,000 price of gold briefly. That's by technical analysis. But again, as I mentioned before, the markets are based on fundamentals as well as technical analysis. Technical analysis gives us an idea where the price levels are going to trade, but the fundamentals of the market really starting to sell off and fear coming into the investor's psyche, this is when they start to protect and owning gold and silver. Now, I want to conclude. I've got a new video that's going to come out, and it's fascinating about the U.S. government debt. And I'm not talking about all the unfunded liabilities. There's more debt than we realize. And it's not hidden. It's actually known. We don't pay attention to it. But regardless, the market is being propped up by debt, and that's a very bad thing, because just in the first 9 months of the year, the U.S. public debt has increased $1,024 billion. That's $1 trillion from January to September 2018. Now, what does that mean? If we look at the gross domestic product, the GDP, and this is by Fred, the Federal Reserve in St. Louis, in Q4 2017 to the third quarter of this year, total U.S. GDP has increased by $828 billion. But the debt has jumped by over $1 trillion. And this isn't all the debt. Now, even though the GDP has only increased a little more than an extra dollar to get this $828 billion of new GDP growth, there's a lot more debt being placed in the markets, like in China. So it's pushed up the average amount. But again, this is a very bad indicator, because when the markets are being propped up by debt, and people need to understand this, when markets are being propped up by debt, energy is being burned to prop up this debt. When energy production starts to decline, this debt is going to implode, and it's going to pull down the values of most assets. But the most important indicator or factor to understand is gold and silver are not backed by debt. Everything else is. So that's the reason why I see a disconnect in the precious metals market. I see investors moving into the precious metals because they're not backed by debt. That's why their values can move up considerably. Now, I want to conclude by showing this chart again. Again, the Dow Jones has shot up due to money printing, massive increases of debt, and that's why we're seeing a much higher Dow Jones average. However, when the markets start to correct, as well as we start seeing a continued lower price in the oil, it's going to be bad news for most assets. So I do believe 2019 is going to be a very interesting year. I think the markets are starting to, this year, we're starting to see trouble. we were already seeing trouble in 2018, but I believe it's going to really increase in 2019. And I do see it as a sign that the gold and silver prices will probably start moving up much higher as the markets correct. Now, thank you for watching this video. Please stay tuned to new videos coming out, especially on debt. And I have one that I'm going to put out on the solar and wind industry, some fascinating information about the solar and wind industry. So if you haven't subscribed to the SRS Rock Report YouTube channel, please consider doing so. And thank you very much.